Happy New Year to everybody, and we're in the first week of 2023. By the time you're watching this, perhaps it's towards the end of January. But I want to just wish everybody a very warm welcome to 2023 because this year is going to be pretty interesting as well. And that's what we're going to talk about on Singapore's real estate market and some predictions and forecasts that we have on the real estate market for the next 12 months. So let's go. Alright, so we're doing Nuggets on the Go episode 1 for 2023. And let's have a look at this recap. This was the news that came out about last month. Of course, if you have seen the latest interest rate, if you have been hunting for a home, you realize that the rates has shot up the roof. And in fact, any fixed rates nowadays is like 4.25, 4.5. In fact, if you can get 4.25, it's considered very low already. Floating rates already inching towards 4%. There's still one more rate hike to go. So 2022, we had 7 rounds of rate hike. This 7 rounds was one of the fastest increment in the history of federal rate hike. So 2022 is really an incredible year because not only was it a year of black swan where we had the cryptocurrency crash, we had the stock market crash, we had tech firm stocks all so-called dipping from all-time highs, and of course we also have the Ukraine war that started towards the tail end of 2021. 2022 was considered the black swan year that everything just happened one shot together. So what's going to happen in 2023? Of course, there's a lot of different kinds of school of thoughts and different analysts are giving different kinds of forecasts and predictions. Some analysts are saying that the stock market will rebound after the Fed pivot. Some predict a recession in US. A lot of analysts and banks are very certain that recession will happen in US. And of course, that is one of the coinciding factor of why Fed will pivot as well because inflation has peaked according to analysts. And when inflation peak, Fed also don't want the inflation so-called to go to a level whereby it's unsustainable. That is why they also cannot maintain high rates for a very long time. They will need to bring down the rates to a more palatable kind of level in case the rate hikes will cause US to slip into very deep recession for a very long time. And that is the reason why Fed will pivot. There might be still one more round to go, probably in March or April. And then the forecast is that once that round hits the roof, Fed will then monitor the inflation figures. If it's brought down to a very nice level, then they might monitor how the economy go. But of course, the next round of things that might happen was this. So this was the news that came out just about on the 2nd of Jan. So when we look at this, so Michael Burry, a very famous investor that was made famous by the show Big Shot. So if you were to look at this, he made this statement on his Twitter account. So basically he says that Fed will cut and government will stimulate because he says that while inflation has peaked, it's likely to pick up again in response to government stimulus. So he's forecasting another round of government stimulus. And what is government stimulus? Government stimulus means QE. So what we're happening right now is that we're expressing QT for the entire 2022 and 2023, but he's forecasting that QE might happen again because the government will then need to stimulate the economy to save the economy from recession. So we might go through this entire cycle of QE again. And when that happens, what does all this mean for the Singapore real estate market? Because we recognize that most of the time, there's this kind of like behavior when it comes to property purchase, property investing, vis-a-vis the stock market performance. Because I don't know whether is it just Singaporeans or whether is it like a global kind of thing, but a lot of people coincides the stock market performance as well as real estate performance. And that is of course true in some countries because if they look at certain countries, for example, in certain states in America, when interest rates rise, and of course usually when interest rates rise, like last year, stock market will correct itself. When interest rates rise, naturally purchasing power drop and people will forecast that the real estate market will start to dip. And that is exactly what happened in certain states in America. But not every state experienced a dip in pricing, only in certain states. And when it comes to Singapore, that mentality also transposes itself right into Singapore because people love to time the stock market. We need to ask ourselves, should we follow this method? Should timing the stock market be similar to using this exact method to time the Singapore market? Because a lot of people in Singapore, a lot of Singaporeans in Singapore, they have portfolio diversification in equity stocks as well as in real estate properties. And they like to link them both together. And we need to understand this key concept. And what is this key concept is that we need to understand that there's always a laggard effect when it comes to real estate because real estate is largely illiquid in nature. We might not even feel the effect if the recession in US is short-lived, and sometimes whatever policies that happens in US, it takes a longer duration to kick into effect into Singapore. In Singapore, we have to understand that we are living on a very different landscape. We're so small, with so many cooling measures. This time around, even though when we look at this, we had a close to like a 18.75% dip since the start of 2022, all the way towards the end of 2022. This is like minus 18.75% in the S&P 500 price index. We came out with this chart as well to look at S&P 500 with Singapore real estate price index. So these three lines right here, you got to see the landed property price index, you got to see the condo apartment price index, you got to see the HDB price index, and this has a dip of minus 18%. This line here is the start of 2022, and of course for the entire 2022, these three lines here, if you talk about the private residential market, they increased by 8.4%. With the latest news that came out. So why is it that the S&P 500 dipped minus 18%, real estate pricing locally still increased by 8.4%? Can we correlate them? Is timing the market effective for the real estate market? What if we are wrong? And what if we're hoping that the real estate market will dip, but it didn't dip? When we look at this, then let me just come up with this three. Similarly, this is 2022. This is of course 2022 as well. There's a line here. So here, an increment of 8.4%. Here, a dip of minus 18%. So everybody is trying to forecast for 2023. Will the Singapore real estate price index starts to drop in reaction to this dip last year? We need to understand this is that if we were to use this same methodology into the real estate asset investment kind of mindset, this is essentially called timing the market. And we're going to talk about timing the market. We talk about a lot in our NOTG episodes before. And is timing the market effective in Singapore real estate market? So we need to understand that there are different strategies when it comes to different types of asset investing. Investing in the stock market is very different from real estate market. They are very different in pricing behaviors, and stock market is essentially very volatile, which presents opportunity for timing the market. Of course, there's like the dollar cost averaging, DCA approach, like, you know, different technical analysis, different value investing. So-called investors, they talk about, you know, you should always stay in the market. If you love that stock, if you love the fundamentals of the company, you think that there's growth, you think that the fundamentals are good, you should always stay in the stock. You don't have to worry about recession that usually lasts for about 1 or maybe 1.5 years. You should stay in the market. You should buy the dip. So usually people like to talk about all this kind of stuff. And the rationale is that stock market being more liquid in fashion. Liquid means that you can enter and exit very easily. And because of the fact it's volatile, there's more room to time the market for exit and re-entry. If you want to dollar cost average, of course, you will re-enter at the dips. You are a proponent that this company will do very well in the mid to long term. You want to stay in the market. That is good, of course. So it depends on your own strategy of investing in the stock market. But when it comes to real estate, we have to understand that it is very illiquid. And to enter and exit a real estate asset, it takes time. When you put it in the market, sometimes you don't get to sell the property for 3 to 6 months. Some people even take up to 9 to 12 months to sell a home, depending on the difficulty level and of course depending on the economy as well. Sometimes buying the property, of course buying a real estate is extremely easy. You can just walk into a showroom, you can buy immediately, but it takes 3 months to complete a transaction. But when you want to exit, it is much more difficult because you need to prep the home. The home has so-called deteriorated in terms of renovation through time. You need to refresh, repaint. You need to strategize your marketing. You need to find the right buyer. Of course, some homes are very easy to exit because they're very rare or the quantum is very palatable. You know, you can be sold in one week, 1 month, and 1 day. We've done all sorts of home selling before. Of course, you can check out our YouTube channel. We've done over 1,600 plus home tours. And it is unwise to time the real estate market because this is essentially a very stable asset. People use it as a store of wealth. And if you were to use the same methodology approach of the stock market to pump it into the real estate market and you are waiting at the sidelines, you might be renting, you might be paying rental for 12, 24, 36 months already. And of course, it's a side topic, but I'm going to do an episode on what is the sweet spot of weighing rental versus biting the bullet to go into the market. Let's say, for example, if you need to pay ABSD or you're a PR or you're a foreigner, you're really thinking about this and you know you've been paying rental for maybe 3 years already. It's really painful and now rental rates has surged so much, it's getting very ridiculous instead for tenants' point of view, but for landlord, all the landlords are really enjoying the high rental rates right now. I'm going to do a separate episode that talk about what is the sweet spot in terms of the number of years and months that you will need to do that flip to buy, because if you were to prolong beyond that sweet spot, then essentially it's not worth it to continue renting anymore, because by renting you are just servicing the mortgage and you're servicing the mortgage interest for your landlord. You're technically like the customer. Of course you get to use the space, but by not owning real estate in Singapore, and real estate in Singapore is a very different ballgame because we have very high ownership rate. 90% of people own homes right here. It's a very different landscape, and prices, rental, they behave very differently. Now, I want to talk about this fact here is that real estate has a very different thing. It eats inflation for breakfast. What do I mean by eating inflation for breakfast is that real estate ride on this thing called inflation. And inflation we break down into two kinds of inflation. One is CPI inflation, one is called an asset inflation. Asset inflation is being pushed by QE and the amount of money that's flooded into the market. So when there's no more money, we call it M2 supply that is being created, asset prices will bump up. And usually this bump up is extremely fast. It can just bump up in 1 to 2 years, just like what we experienced in the last 2 years for the landed property market. And real estate being a very tangible asset, it eats inflation for breakfast. Now, the key rationale is because, firstly, this is a safe haven. People like to pump money into real estate to store their wealth. And if you notice, millionaires, billionaires, they get very wealthy over the years because they own a lot of real estate. And their real estate just increase in pricing while they sleep, while they carry on their business, while they carry on their professional life. And asset prices actually eats inflation for breakfast. There's one more thing that's happening below the scene, behind the scene, is that your mortgage, your debt, and in real estate, your debt is considered a good debt because this is considered a leverage point. Banks love to loan people when it comes to buying a property, and they love to give out mortgages because why? Because if you cannot pay your mortgage for 3 months, they take your property. There's also a nice leveraging point in the sense that you pump in 25% down payment, you have skin in the game, the bank loan you 75%. As long as you have proof of income, you have a stable salary, you have a stable business, you have a stable kind of inflow of income every month, the bank find that you're suitable to loan you the mortgage, they will loan to you because there is a collateral on the mortgage itself, which is the physical property. They can always take the property, you can auction it off. Mortgage, being a good debt, has one more effect, is that it's eroded by inflation as well. So take note that the money that you're holding, the currency that you're holding on hand, is eroding in its value through time because of inflation. The $100 that you have, or the $1,000 that you have in the bank, in 2 years' time, is going to worth less. You're going to only be able to buy lesser things in 2 years' time. The $1,000 you have will get weaker over the next 5 to 10 years. So that also means that this 75% loan that you're loaning from a bank is going to get lower in value in terms of the absolute value that you're going to have in the next 5 to 10 years. So that is the reason why mortgage debt is also eroded by inflation, and that is forming this V curve right here. So your asset price is going up, but your mortgage is going down in terms of its value itself. So technically speaking, when you look at this component, this is a fantastic thing of why people love to own real estate in the world. 2023, what is going to be the forecast before we end this episode? Now, 2023, a lot of people are waiting at the sidelines because they are hoping to see the impact of the high interest rates that we are right now, and everybody is waiting at the sidelines. And 2023 is going to be the year with at least close to about 40 new launches coming up because there's been so much en bloc and government land sales in the past years. But if you were to look at some of the latest news, our government is monitoring the market very closely, and just by looking at this news, you know that our government know that the amount of land is not enough because the unsold housing stock has hit a 15-year low. And just last month, our government is pumping up the amount of GRS because they know that developers' appetite is so strong. Through the strong bidding last year, developers are hungry for land because they have already cleared a lot of their launches in the past few years. A lot of properties are also going to TOP this year. This shows a sign that the market is hitting a signal that the developers want more land, and there's a lot of underlying demand in the market. Of course, if you look at the latest launch right here as well, you also notice that you also ask yourself this question, like, where are all these buyers coming from? You know, I thought that 2022 wasn't a good year, but where are all these buyers coming from? So I want to end this episode with this key thing, and then we'll move into the second episode talking about part 2 of our forecast for 2023. Now, we want to dive into the mindset of the existing owners and investors because this will give us a very nice sort of thinking on the behaviors of existing property owners as well as people that are waiting on the sidelines hoping to buy a property. Perhaps you've been waiting for the past 24 months because you have exited maybe in 2020 or 2021 and you're hoping that the market will crash so that you can come in and buy cheap. Now, everybody hopes for that to happen, but just have a look at our pricing for the past 10 years but the market really crashed. And watch back our previous episode on why we think that Singapore market is different because we have 13 rounds of cooling measures pumped into the price. We are very sticky right now in terms of the stickiness of our pricing. Nobody is selling their property cheap. Has high interest rate last year in 2022 change behaviors? Will people start to fire sale their property in 2023? Will developers start to drop price in 2023? And that will help us to end our episode today now. Let's have a look. Quick recap. Last 7 rounds, only one round, 97. But this rounds that I'm circling right here has no dip in pricing when interest rate rise. The reason is because there has been so many cooling measures. So I want to ask you this question. If you currently own 1 to 2 properties, so now we're in January 2023. Let's say you have 2 properties. One you're staying, one you have been renting out. What will happen when you see this news article tomorrow? So take note, this is a fictitious news article. I just edited a little bit. So it's just for this little mini illustration that we're doing together. So you suddenly see that all the banks are cutting interest rate to 1.5%. Now, what will be your mindset if you're a property owner? And let's say you are planning to exit one of your property or maybe 2 of your property because you want to upgrade to a landed home example. This will be what will be going through your mind. If you own 1 to 2 homes, you will definitely increase your asking price now because now you know that the buyer's demand is much higher. Everybody want to come in and buy properties now because the interest rate is so low. So as an existing owner of 2 properties, even if you want to sell, you will sell high. Second question, if you're a property buyer and investor waiting on the sidelines because you have sold your property last 2 years or maybe you have not purchased a property before but you're trying to time the market, you're waiting for the market to dip, what will happen tomorrow morning when you see this news that interest rate is now 1.5%? This is what will go through your mind. You will tell yourself that you want to quickly buy now because interest rate is so low and you know that you have to buy now because if you don't buy now, prices are going to shoot up again, so you want to buy now. But the question is, will you be too late by then? Because remember the first question, all the existing owners that are holding on to properties right now, they will not sell cheap anymore. They will want to raise their asking price because the demand is back. Third question, if you're a developer, you have a couple of launches that you want to launch in 2023, you wake up tomorrow as the owner of all these launches, you're the boss of all these launches, you own land, you meet your architects, you have a team, and you're maybe a small developer or a big developer. You wake up with this news on the table. What will you do as a developer? You will definitely increase your launch price because you know that the buyer's demand is now back. There's no fear of not being able to sell, no fear of not being able to clear your units in the next 5 years. Fourth question, if you have just bought your property January 2022 for your own stay for your family and you wake up tomorrow and suddenly you see that the interest rate now increased to 5% or even 6%, my question is, will you fire sale your home that your kids are enjoying every day and is so near to their school? This is really for your shelter, is for you to build your family, for you to really let your family have a nice and safe place to live in and enjoy the space. Will you fire sale your home? I don't think so because you and your wife are working, you have CPF, you have some savings in your CPF, you have some savings in cash. There's no need for you to fire sale the home. I mean, worst come to worst, even if one of you were to lose their job, most people will be able to at least service the mortgage for the next 6 to 12 months to find another job. I mean, why do you need to fire sale your home? This is what will be going through your mind, is that you might have already locked in a fixed package at the start of the year at maybe 2.5%. You're ready to hold this property for 3 years because when you buy, you already have the pre-knowledge that you have to hold it for 3 years. You have paid 25% down payment and 4% buyer stamp duty. You have skin in the game. You have 29% down into this home. This is for your own stay. Your kids are happy here. There's no need for you to fire sale the home. Fifth question. If you have just bought a second property in January 2022, which was 12 months back, and you have paid ABSD, and you saw this news now in December 2022, my question is, will you still fire sale your home? And why will you do that? Because let's say you're a single property investor, you're not married, you have a property for your own stay, and you bite the bullet, you pay ABSD to own a second property to rent out. When you see a high interest rate environment, will you fire sale? No, you won't, because you already know that you have to hold for 3 years. The worst thing is that because you bite the bullet, you have so much skin in the game. You paid 17% ABSD, you paid 4% buyer stamp duty, you paid 55% down payment because you can only loan 45% from the bank and your money installment is so low, you will continue to rent out. There's no urgency to sell. In fact, I think you might be enjoying passive income right now. So leave a comment below if I'm right to say that you're actually enjoying passive income right now because rental rates have shot up so high. Your spouse and yourself, you own 1 property each. 1 for your own stay and 1 for investment. So both of you will decouple. 1 is for own stay, 1 is for investment. Maybe you own a 3-bedder for stay, you own a 2-bedder for rental. Will you fire sell your home today? Because the interest rate is so high. Similarly, you are ready to hold for 3 years. You have paid 29% for both your properties. You're using CPF to service this property, to service this property. They're collecting good rental. There's no need for you to sell. Even if you want to lose your job, you can still use rental to pay for the mortgage. That's the last thing, is that if you are from overseas and you are already owning 3 to 4 properties in Singapore, will you fire sale your home? Now, the answer is this. You already pay ABSD over the years. You will never sell all the properties because if you were to sell and you buy back another property, you'll be hit by the new ABSD. You will continue to collect rent. You will let your Singapore currency appreciate against your native currency, which works well for you, and that's an added advantage for foreign property investor. And we've just concluded all the 6 different categories of demographics of property owners, as well as one of the demographic is people waiting on the sideline. So I think if you're waiting on the sideline, we need to look at the whole picture together. Is that we need to look at the existing people holding on to properties, because their holding power determines the price and valuation point of the Singapore property price index. And if you look at who is currently owning the properties, based on the statistics in the last few years, we no longer need to depend on foreigners on the property price index, because 76% plus 21% of the properties that are done deal in the last few years actually are done by Singaporeans and PR. And that is an extremely high percentage, because a lot of people thought that we need to have foreigners, investors coming in to buy a property to push up our pricing. But actually, this is a reverse picture already because of all the cooling measures. In fact, we became sort of like a self-sustaining kind of country right now. Most of people buying properties, they are people already in Singapore. They are locals, and this is a very strong base fundamental pool of buying power that we have in the market right now. Last but not least, is that we have to understand this very important fact, is that we churn out this chart. The existing people, so in Singapore, there's 340,000 current stock of condos and apartments. And we're talking about condos and apartment strata units. 260,000 are owned by Singaporeans. 70,000 of these units are owned by foreigners and PR. What this means is that PRs and foreigners, they have more skin in the game, because PRs pay 5% ABSD, foreigners pay between 12, 17, all the way to currently 30%. It was 25%, increased to 30%. So over the years, foreigners and PRs have a lot of skin in the game. Now, the mindset of the foreigners and PRs holding on to property in Singapore is that they have a lot more stickiness and they will not sell, because if they were to sell and buy back again, they'll be hit with a fresh round of ABSD at the latest highest round. So technically speaking, if you want to buy a property in Singapore, you have to wait for this pool of current owners to release their units in the market. And this is a dwindling pool, because there's lesser people that are willing to let go of their units that they're holding. And of course, then you have to depend on new launches. You have to wait for existing Singaporeans that want to upgrade their portfolio or downgrade. And what does this mean is that this entire picture then forms a new level of stickiness in the entire market. To sum up this episode, part 1 of our forecast and prediction for 2023 is that 2023 is going to be a very interesting year, because this is going to be a year that we will see a U-shaped turn, and that is what we call a shift. And if you're not ready for the shift, you're trying to time the market, and when the shift comes and you want to enter the market, you might be further priced out of the market. It is better sometimes to enter the market, to really deep dive, do your homework, do analysis, really deep dive, enter the market, so that by the time when you flip open the newspaper tomorrow and when Fed decide to cut their rates and everybody wants to increase their price, you will not be caught by surprise, because you're already in the market, and that's the time that you can let your property benefit upwards with asset inflation, because you are already in the market. So I want to end this episode, part 1, on forecast and predictions for 2023. I just want to wish you a wonderful year ahead. Thank you for following PropertyLimBrothers over the years, and we hope that our Nuggets on the Go series has helped you, whether you're traveling on the road listening to our Spotify, or you're at home watching this on YouTube. And thank you for staying tuned with us. My name is Melvin Lim, CEO and co-founder of PropertyLimBrothers, and we're very happy to have a new season for Nuggets on the Go. So we'll see you on the next episode. Stay tuned. Cheers.
I've been holding my cough.
Oh my poor pain. Christ in next. Please forgive my handwriting. It's a little bit like sometimes I also don't know what I'm writing about. So